Welcome back to another video. Today I'll be speaking about how to trade liquidity. Now, first of all, what is liquidity? Liquidity is basically losers, and that's one way to put it. However, it's essentially that large financial institutions such as the Fedwire, when they're making transactions for big purchases and big payments, they essentially need money to actually make those transactions go through. You could do your own research. Just type up Fedwire clearing houses, and yeah, you'll probably be led down a rabbit hole. You might have heard of the new financial payment plans coming to 2024, 2025, ISO 2002 something along those lines. But yeah, so when these large financial payments are being made in the mornings of that at the London session and the New York sessions, they're basically, to make a transaction of like 3 trillion, they need to, make liquidity in the market. They need to get some losers in, take some more money away from the market to actually make these transactions. In the sense, you have to think of it as, in the game that we're in, casinos do the same thing. In order to pay winners, they need losers. In fact, if you've ever done a funded account, you're wondering how these websites pay you. Is from people taking challenges and failing. So those are two examples of how liquidity is used to actually pay people, and one of the biggest things in trading as well. So liquidity, there's two types of liquidity. There's buy side liquidity and there's sell side liquidity. Buy side liquidity includes everything from these two things. So you have I'll just draw this out for you. So say that's market execution in the middle here. You have buy limits, which are below the market, and you have sell stop, which is below the current market price. Market execution is the current market price. So when you're on your MT4, when it says market execution, what happens when you click that? You would be sent straight into the trade. Above the market execution, you have buy stops and sell limits. And price comes up to either of this thing. So most of the time for buy stops, it will be a breakout structure. So for instance, this candle here, as soon as price breaks this candle here, you'll be sent into the trade, barring spread, probably be sent up around here. Not as soon as it breaks. As soon as it breaks, you'll be sent into the trade. This is a buy stop. For sell limit, as soon as it breaks up here, you would be entered into a sell. Obviously, you hoping for the market to return down, just as it did so here. For buy limit, you would be entering below the market price. Market price is trading through here at 1945.182. As soon as it breaks down here, you'll be in here expecting price to go back up, as it did so here. For a sell stop, you will be getting in on a continuation to where as soon as it breaks this price here, you'll be hoping for it to trade lower, which it did here. Now, I personally use sell side, buy side, all liquidity as targets. Sell side liquidity allows you to basically guess where you think the market is going to end up. You want to be using the higher time frames to actually give you a target. Essentially, this is equal. These are two equal lows here, and you use this as a target. So when you see these two equal lows here and prices looking something like this, you'll be interested in that. As prices here as well, you would also be interested in buy side liquidity, which is here. And only when you see your confirmations for where price is going to go, as we are not genies, we do not know where price is going to go ever. We do not know ever. So you mark out areas of interest to where price may be drawn to, which is sell side liquidity and buy side liquidity. So these are the 2 points here. These are both, this is a swing low, this is a swing high. These are where buy side rests. That's where the most of buy side rests, as most retail traders, SMC traders, large banks. Swing highs and swing lows is where price has changed direction after also taking out liquidity as well. As you can see here, liquidity to the left hand side. This is sell side, previous sell side. This is sell side, previous sell side. Now, sell side liquidity and buy side liquidity can be seen at the very top of the wicks, which is that long line that has no color in it. It's just a straight stick. You can see these are the wicks. Liquidity is also at the bodies of these candles, especially on the higher time frames. As we can see here, if you was to put your lines here, you can see if we put the line here and then we go down to lower time frames, you can see that in these areas you would be able to find swing highs and sticks in this area as well. A common area to where liquidity also rests is imbalances, fair value gaps, places where there's no wicks in sight. And you can see here, if we draw a box here, you can see that this is an area of interest because there's no sticks here. This means that price has moved very quickly from this area for whatever reason, and price may or may not return back to this area. If we move forward on the candles, you can see price didn't return back to these areas. On the smaller time frames, you can see that price did in fact return to these areas. Times is very specific to the raiding of liquidity. That's where price goes into these areas and then reverses from it. Time and price is what ICT likes to say, and the price aspect, I like to see it as the closing of candles. Where does the candles close in relation to these points of interest, which in this conversation are draws on liquidity, which we stated were these swing highs, so these wicks, the top of the wicks, and these imbalances, which are places without any wicks. So you can see here, price has returned to the consequent encroachment, which is the 50% level. This is the 50% level. I'm going to spell this terribly, but this is the 50% level of imbalances, places without any wicks. So price returned to the 50% level of this and then closed below the fair value gap. When you see candles close below or above a candle, that will tell you the direction that is going. And you can see here, price closed above the 50% level of this imbalance, which gives you a confirmation that price is going to what? Not break through. It's holding as what do the retail calls it? Foundation, a bottom. That will give you confirmation that price does not want to trade through it. If price, let's say, closed below the 50% level of any fair value gap, then you can see that price is not respecting it, and we'll probably see lower or higher prices. In this case, we saw it here. The 50% level of this candle was disrespected on that second candle. This second candle closed way above it, and then we saw higher prices. In relative to time, you want to be trading, depends on what you're trading, London Open, which is 7 a.m. well, New York time, 2 a.m. to 5 a.m. New York time. If you go into your charts, go to the bottom right corner of Trading View, you can see here it says UT4. Just click that and scroll all the way down until you find New York, which is UTC -4. New York Open, which is 8:30, or sorry, 7 a.m. to 10 a.m. This is the New York kill zone. This is the London kill zone. In these times, in particularly, you'll be able to see high probable trades as price respects these imbalances, disrespects these imbalances, and looks for draws on liquidity. This candle right here is at 8 o'clock. It closes at 8 o'clock. 8 a.m. close. Then at 8, this candle closed at 9 a.m. You can see how this candle at 8 o'clock closed bullish. This is a confirmation candle for higher prices, especially as price did not close below the 50% level of this wick, which is also consequent encroachment. Just going to put C.E. Bless me, thank you. Now, in terms of time and price, at 8 o'clock, we're in a good time to trade the market, so time is now on our side. Price, the candle was happening where it is the candle's price. Price has closed above the 50% level of this long swing low, which then gives us more confirmations to gamble higher prices. Whether you decide to get in it or not is up to you. From this closing above this consequent encroachment, it reaches up to the 50% level of this imbalance here. Now you can choose this one here, but as you can see, it's not very strong. This one has yet to be tapped into, where this one has been tapped into and has gone lower. We expect for price to rip through this and tap into this next one, which has been untapped into. A big tip when you're on the markets trading live and it's 8:30 and you don't know what's going to happen next, and you got a million things in your head thinking up, down, up, down, up, down. As you're seeing here, you could possibly think, okay, price is closed bullish and it's tapped into this level here. You might be thinking, I don't know where it's going to go. The biggest things to do is write things down on your chart. So for example, I would write down here, if price closes below this fair value gap, fair value gap, I will sell. As simple as that. That takes the weight off your shoulders and makes it easy for you to now sell the market when price gives you an opportunity to do so. It reduces the amount of thinking that you have to do. Oppositely, that's not a word, but if price closes above this FVG, I will buy. Writing things down on your chart, right, is probably one of the #1 ways to not go against your own decisions. A lot of the time, we have many, like we know what's going to go on after you've drilled in loads of chart time and you understand candles and whatnot. You'll get to a stage where you know what's going to happen, and then you do the opposite. To get rid of that, to get rid of those mistakes, you write down what you're going to do, and you just leave it on your chart. And if that happens, then you go through with what you're planning to do. And if it doesn't, then that's completely fine. We're going to build up this abundance mindset where there's many trades to be taken. Finally, just going to end off on saying that liquidities, draws and liquidities, the spaces without any wicks, the top of candles, the roofs of different trends, the bottoms of different trends, can all be used as a magnet. That is essentially what they are. They are a magnet to us. Just like this magnet here. Just not going to use that one. I want to get a picture out for you guys, because I know you guys like pictures. I can find it. Look. Anyway, that magnet. So use it as such. Right? This is a magnet. Up here is a magnet. That's all they are. So when price is getting ready to move, you just see it as a magnet. You're like, okay, I think I know where price is going to go. These are the possible places. Thank you for watching.